Right now, while you're watching this video, silver just did something it's only done 7 times in the last 50 years. And every single time it happened before, what followed changed everything. I'm not talking about a small market correction. I'm talking about 2008. I'm talking about the dot-com crash. I'm talking about moments when millions of people woke up to find their retirement accounts cut in half. Silver moved first, every time, and it's moving again right now. Here's what nobody's telling you. Silver isn't just some shiny metal people collect. It's a warning system built into the economy itself. And when it starts screaming, you better pay attention. Because unlike the talking heads on financial news, who profit from keeping you calm, silver has no agenda. It just reflects reality. Cold, hard, mathematical reality. And right now, that reality is starting to look terrifying. But here's the thing. Most people have no idea this is even happening. The stock market looks fine. Your 401k might even be up. The news keeps saying the economy is strong. Everything seems normal. That's exactly how it looked in early 2008 too. 6 months before the world fell apart, everything looked normal. You know what wasn't normal? Silver prices. They were already trying to tell us something. Nobody listened. So if you want to understand what's really happening beneath all the optimistic headlines, if you want to see what the smart money is already preparing for, stay with me, because what I'm about to show you isn't theory, it's pattern recognition. And the pattern is crystal clear. Before we go deeper, do me a favor. Hit that like button and subscribe to the channel. This is information that doesn't get shared on mainstream media. And the only way it reaches people is if you help spread it. Alright, let's dive in. Let me explain exactly what makes silver different from every other investment you've ever heard about. Gold gets all the attention. When people think about protecting their wealth, they think gold, safe haven, store of value. Gold is the boring older brother who went to law school and now manages a trust fund. Everyone respects gold. But here's what they didn't tell you. Silver is the younger brother who dropped out of business school, started 3 companies, works in manufacturing, and somehow knows exactly when the economy is about to implode. Silver doesn't just sit there looking pretty. Silver works. Silver moves. Silver knows things. See, gold is primarily a monetary metal. When people lose faith in paper currency, they buy gold. Simple. But silver is living a double life. It's both a monetary metal and a critical industrial material. This is crucial. This is everything. Because while gold just reflects fear and currency problems, silver reflects fear and the real economy at the same time. It's getting signals from 2 completely different sources. And when both of those sources start sending distress signals simultaneously, that's when you need to pay attention. Think about it this way. Gold is like a smoke detector that only monitors one room. Silver is monitoring the entire house. It's tracking monetary policy, yes, but it's also tracking manufacturing demand, industrial production, credit markets, technology sectors, energy infrastructure, defense spending. Every major system in the modern economy touches silver somehow. Solar panels need silver. Electric vehicles need silver. Every smartphone, every computer, every advanced weapon system, they all need silver. You cannot run a modern industrial economy without silver. There is no substitute that works as well. So when silver prices start moving aggressively, it's not just saying people are scared. It's saying people are scared and something is breaking in the production economy. And liquidity is getting weird and credit conditions are changing. It's a multi-layered warning system. And right now, all those layers are lighting up. But here's where it gets interesting. Silver often moves before the crisis becomes obvious, not during. Before. Sometimes months before. Because the big money, the institutional money, the money that actually understands how the system works, they don't wait for CNN to tell them there's a problem. They watch silver. They watch credit spreads. They watch obscure indicators that normal people have never heard of. And when those indicators start flashing red, they quietly reposition. They don't announce it. They don't tweet about it. They just move. And one of the first places they move is silver. Let me paint you a picture of what the USA economy looks like right now if you actually examine it honestly. Turn on the financial news and what do you see? Smiling anchors talking about GDP growth, employment numbers that look decent, stock markets near all-time highs, corporate profits still flowing. Everything is fine, everything is stable, the economy is resilient, we've achieved a soft landing, inflation is coming down, the Fed has everything under control. That's the story, that's the official narrative. But here's the thing about official narratives. They're designed to manage expectations, not reveal truth. Financial markets don't reflect economic health. They reflect liquidity. They reflect monetary stimulus. They reflect expectations about future central bank policy. You can have markets going up while the real economy is quietly deteriorating underneath. It's happened before. It'll happen again. Think about what's actually happening right now beneath those happy headlines. The US government is borrowing money faster than at any point in peacetime history. Not just borrowing it, but accelerating the borrowing. We're adding $1 trillion to the national debt roughly every 100 days now. Every 100 days. Let that sink in. $1 trillion. That's not sustainable. That's not normal. That's not fine. And here's where it gets worse. The interest payments on that debt are exploding. We're now spending more on interest payments than we spend on defense, more than we spend on Medicare. The fastest growing line item in the federal budget isn't education or infrastructure or anything productive. It's interest, money we're paying just to service the debt we already have. And because rates went up, those payments are accelerating. We're borrowing more money at higher rates to pay interest on money we borrowed before. Does that sound stable to you? But wait, the stock market is up, right? Yeah. You know why? Because companies have been buying back their own stock with borrowed money. Because pension funds and asset managers have no choice but to stay invested because bonds don't pay enough to meet their obligations. Because retail investors keep dollar cost averaging into index funds because they've been told that's what you're supposed to do. Because the entire system is structured to push money into equities, regardless of valuation. The market can stay elevated while underlying fundamentals decay. For a while. Not forever. Most official economic indicators are lagging indicators. They tell you where things were 3 months ago, 6 months ago. By the time recession shows up in GDP data, the recession has usually already started. By the time unemployment spikes in official statistics, companies have already been quietly cutting for months. The official story is always behind reality. Always. Silver doesn't wait for official confirmation. Silver responds to what's actually happening right now in credit markets, in currency flows, in industrial orders, in institutional positioning. Silver is a leading indicator, and right now silver is trying to tell us something. Let me tell you exactly what rising silver prices really mean. Silver doesn't just randomly go up because people feel like buying it. It moves for specific reasons. And when you understand those reasons, you can read silver prices like a language. Let me translate what silver is saying right now. First, silver rises when confidence in fiat currency weakens. Not collapse, not hyperinflation, just weakening. When people start to feel, even unconsciously, that holding paper dollars might not be the best long-term strategy, they look for alternatives. Some buy gold, some buy silver, some buy Bitcoin. But silver has been doing this job for thousands of years. It's the OG hedge against currency debasement. And here's the thing about confidence. It erodes slowly, then all at once. You don't see it happening in real time. You see it in retrospect. But silver sees it happening now. Silver feels the shift before the shift becomes obvious. Second, silver rises when real interest rates decline or go negative. Real interest rate means the nominal interest rate minus inflation. If inflation is running at 4% and your savings account pays 2%, your real return is negative 2%. You're losing money in real terms. When real rates are negative, holding cash is a guaranteed loss. Holding bonds becomes less attractive. Suddenly tangible assets start looking better. Silver starts looking better. And right now, even with rate cuts potentially coming, real rates are still compressed relative to actual inflation people experience. The math doesn't work. People are waking up to this. Third, silver rises when credit conditions tighten, when banks become more cautious about lending, when corporate borrowing costs increase, when credit spreads widen. These are early signs of financial stress. They happen before defaults spike, before bankruptcies hit the headlines. Silver is sensitive to credit conditions because industrial demand depends on business investment, and business investment depends on credit availability. When silver rises, despite signs of credit tightening, it's telling you that the monetary demand is overwhelming the industrial demand signal. People are moving into silver not because the economy is booming, but because they're hedging against systemic risk. Fourth, silver rises when inflation expectations become unstable. Not high, not low, unstable. When people stop trusting that inflation will be 2%, like the central bank promises. When the range of possible outcomes widens. When uncertainty increases. Silver thrives in uncertainty about purchasing power. Because unlike a bond that promises you fixed dollars in the future, silver is real. It's tangible. It can't be printed. It can't be diluted. Its value doesn't depend on promises from governments or central banks. Now here's what's crucial to understand. Silver often makes these moves before recession, before financial crisis, before major market corrections. Not during, before. In 2007, silver started moving up aggressively in the first half of the year. The financial crisis didn't hit until 2008. Silver knew. In late 1999 and early 2000, silver started acting weird right before the dot-com crash. In 1987, silver showed unusual strength in the months before Black Monday. Pattern after pattern after pattern. Can you believe this? A metal that comes out of the ground is somehow better at predicting economic stress than the entire economics profession combined. Better than the Federal Reserve with their hundreds of PhDs and their sophisticated models. Better than Wall Street analysts with their Bloomberg terminals and their insider access. A simple metal that humans have valued for 5,000 years is outperforming modern economic science at detecting systemic risk. Why? Because silver has no incentive to lie. The Fed has political pressure. Wall Street has quarterly earnings to worry about. Economists have careers and reputations to protect. Silver just is. It responds to supply and demand, to fear and confidence, to math and physics. And right now, the math is screaming. Let me show you what's really driving stress in the US economy and why silver is responding. The United States economy is running on borrowed money. Not just some of it, most of it. Debt is not a side feature of the economy anymore. Debt is the economy. Let me give you numbers that should terrify you. Total US debt, combining government, corporate, and household debt, is now over $90 trillion. $90 trillion. That's more than 4 times our entire GDP. For every dollar of actual economic output, we owe $4. Think about that in personal terms. If you made $50,000 a year and owed $200,000, excluding a mortgage, you'd be in serious trouble. That's where we are as a country. Government debt alone is approaching $36 trillion and climbing. The deficit this year will likely exceed $2 trillion. Again, we're running multi-trillion-dollar deficits during economic expansion. What happens when recession hits? What happens when unemployment rises and tax revenues fall and automatic stabilizers kick in? The deficit could explode to 3 trillion, 4 trillion, and all of that gets added to the debt. And all of that debt requires interest payments. Here's the mathematical trap we're in. Interest payments on federal debt are now exceeding $1 trillion per year. 1 trillion. That's more than 13% of all federal revenue going just to interest, not to programs, not to infrastructure, not to anything productive, just interest. And as debt grows and rates remain elevated, that number grows. Soon it'll be 15% of revenue, then 20%. At some point, an unsustainable portion of the federal budget becomes just servicing existing debt. This creates a death spiral dynamic. More debt leads to higher interest payments. Higher interest payments require more borrowing. More borrowing leads to even higher future interest payments. The only way out of this mathematically is 3 options. Option 1, grow the economy fast enough to outrun the debt. Not happening. Growth is sluggish. Option 2, cut spending dramatically. Politically impossible. Try taking benefits away from voters and see what happens. Option 3, inflate the currency. Print money. Suppress real interest rates. Quietly erode the real value of the debt through inflation. Guess which option they're going to choose? They've already chosen it. They chose it in 2008. They chose it in 2020. They'll choose it again. And when they choose it, what happens to paper currency? What happens to bonds? What happens to anything denominated in fixed dollar amounts? They lose value in real terms. And what happens to tangible assets like silver? They rise. Not because silver becomes more valuable, because dollars become less valuable. Silver is watching this debt trap in real time. Silver knows there's no way out except currency debasement. And silver is positioning accordingly. But here's what they didn't tell you about the dollar. Everyone talks about dollar strength. You'll hear analysts say the dollar is strong because the dollar index is holding up. The dollar is strong because it's outperforming the euro or the yen. And sure, relative to other fiat currencies, the dollar might look okay. But here's the thing. All fiat currencies are in a race to the bottom. Saying the dollar is strong because it's beating the euro is like saying you're the healthiest patient in the ICU. Congratulations, you're still in the ICU. What matters isn't the dollar's value relative to other currencies. What matters is the dollar's purchasing power domestically. What can you actually buy with a dollar? How much does housing cost? How much does food cost? How much does healthcare cost? How much does education cost? Those are real costs. Those are the costs that determine your actual standard of living. Official inflation statistics say inflation is moderating. They'll tell you it's coming down, maybe 3%, maybe approaching the Fed's 2% target. But ask yourself, does your actual cost of living reflect 3% inflation? When you go to the grocery store, are prices 3% higher than a few years ago, or are they 30% higher? When you look at rent, when you look at insurance premiums, when you look at childcare costs, do those numbers feel like 3%? The way they calculate CPI has changed multiple times over the decades. They use substitution effects. They use hedonic adjustments. They use methodologies that, let's be honest, are designed to make inflation look lower than it actually feels to normal people. I'm not saying it's a conspiracy. I'm saying the incentives push toward understatement. Governments don't want to admit high inflation because it makes them look bad and it increases the cost of entitlement programs that are indexed to inflation. Silver doesn't care about CPI calculations. Silver responds to actual loss of purchasing power. Silver responds to the real inflation that people experience when they try to buy a house or feed a family or pay for healthcare. And silver is telling you that real inflation, the kind that matters, is higher than official numbers suggest. Much higher. This is why silver is rising even when official inflation data shows moderation. Because silver isn't tracking government statistics. Silver is tracking reality. And reality is that the dollar's domestic purchasing power continues to erode at a pace that exceeds what they're telling you. Now let me explain why silver's industrial demand makes this situation even more intense. Silver isn't just a monetary metal, it's essential to modern technology. This is what makes it different from gold. Gold is nice to have. Silver is necessary. Let me walk you through where silver goes and why it matters. Solar energy is exploding globally. Every solar panel requires silver for conductivity, about 20 grams per panel. As the world transitions to renewable energy, silver demand from solar alone is projected to consume massive amounts of annual supply. And you can't substitute it effectively. They've tried. Silver conducts electricity better than any other element. You can use copper or aluminum for some applications, but in solar panels, where efficiency matters, where space is limited, you need silver. Electric vehicles use significantly more silver than traditional cars. The electrical systems, the charging infrastructure, the power management systems all need silver. As EV adoption accelerates, silver demand accelerates with it. Electronics. Your phone has silver in it. Your laptop has silver in it. Data centers use silver. 5G infrastructure needs silver. AI data centers, the massive computer farms that run artificial intelligence, they consume enormous amounts of electricity and require sophisticated electrical components. Silver is in those components. The more we digitize, the more silver we need. Defense and advanced technology. Silver is crucial in aerospace, in weapon systems, in radar, in sophisticated electronics that militaries depend on. And right now, with global tensions rising, defense spending is increasing. That means more silver demand. Medical applications. Silver has antibacterial properties. It's used in wound care, in medical devices, in hospital equipment. That demand is steady and growing. Here's the problem. Silver supply is relatively inelastic. You can't just mine more silver because prices go up. Most silver comes as a byproduct of mining other metals like copper, lead, and zinc. Only about 30% of silver comes from primary silver mines. This means silver supply responds more to demand for base metals than to silver prices themselves. If copper demand falls, silver supply falls, even if silver prices are rising. It's a weird dynamic that creates potential supply squeezes. And recycling doesn't solve the problem. Yes, some silver is recycled from electronics and industrial use, but much of it is lost forever in tiny amounts across millions of products. You can't economically recover the microscopic amount of silver in your phone. It's gone. Unlike gold, which mostly gets recycled because it's valuable and visible, silver gets consumed and dispersed. So you have growing demand from multiple industrial sectors that are all expanding, and you have inelastic supply that can't respond quickly to price signals. What happens when you combine that with increasing monetary demand from people hedging against currency debasement? You get upward pressure on prices. Serious upward pressure. That's what we're seeing now. But here's where it gets really interesting. Even during economic slowdowns, many of these industrial applications continue. The transition to solar doesn't stop during a recession. Defense spending doesn't stop. Data centers keep running. This creates a floor under silver demand that didn't exist in previous decades. Silver has become more essential, not less, as technology advances. This is why smart money is paying attention. The supply-demand fundamentals for silver are tightening at the same time monetary factors are supporting prices. When you get convergence like that, when multiple forces push in the same direction simultaneously, that's when assets can move dramatically. Let me tell you why silver moves before the crisis becomes obvious to everyone else. Silver's market is small compared to stocks or bonds or real estate. The entire above-ground silver supply is worth maybe $50 billion. Compare that to the US stock market at over 40 trillion. Compare it to the bond market. Compare it to real estate. Silver is tiny. This is actually an advantage for reading economic signals because small markets move faster. When institutional money starts rotating even a small percentage of assets toward hard assets and alternative hedges, that flow shows up immediately in silver prices. Big money doesn't wait for mainstream media to confirm a crisis. And by the time CNBC is talking about recession, the smart money has already repositioned. They're watching leading indicators. They're watching credit spreads, watching repo markets, watching currency flows, watching interbank lending rates, watching obscure derivatives, markets that normal people don't even know exist. And when those indicators start flashing warning signs, they act quietly, without announcement. One of the places they position is precious metals. Gold, yes, but also silver, because silver offers more upside potential due to its smaller market size and its industrial leverage. And when they start buying, prices move. Those early price moves happen months before the crisis becomes obvious. That's the warning. That's the signal. Think about 2008. Bear Stearns collapsed in March 2008. Lehman failed in September 2008. But silver and gold had already been rising throughout 2007 and into early 2008. The smart money knew this subprime mortgage situation was unsustainable. They knew the leverage in the financial system was insane. They knew it would break eventually. They didn't know exactly when or exactly how, but they knew enough to position defensively. Silver moved first. Most people didn't pay attention until after the crisis hit. By then, it was too late to position. The same pattern played out before the dot-com crash. The same pattern played out before the 1987 crash. The same pattern played out before the 1970s stagflation. Silver moves before the crowd realizes there's a problem. Not because silver is magic. Because silver reflects the actions of people who understand the system better than the general public. Right now, silver is moving. Right now, silver is telling you something. The question is, are you listening? Let me tell you exactly what silver might be warning about right now. We have an economy that looks stable on the surface but is built on unsustainable debt. We have a currency that's losing purchasing power faster than official statistics admit. We have markets elevated by liquidity rather than fundamentals. We have credit conditions starting to tighten. We have geopolitical tensions increasing. We have interest payments on government debt spiraling out of control. We have a Federal Reserve trapped between fighting inflation and preventing financial instability. Silver is looking at all of this and saying something is wrong. Something beneath the surface is fragile. Maybe it's confidence in monetary stability starting to crack. Maybe it's growing stress in credit markets that hasn't shown up in defaults yet, but will. Maybe it's overvaluation in risk assets that can't be sustained. Maybe it's recognition that the path forward involves currency debasement, whether we admit it or not. Silver doesn't predict exact events. Silver doesn't tell you that on March 15th, the market will crash or that a specific bank will fail. That's not how it works. Silver reflects pressure building within the system, stress accumulating, fragility increasing. And the message right now is clear. The risks are growing. The stability is more apparent than real. The system is more fragile than it looks. Ignoring these signals has historically been costly. In 2007, people who paid attention to what silver and credit markets were saying had time to prepare. People who waited for official confirmation, who believed everything was fine because that's what they were told, lost fortunes. In 2000, people who noticed the warning signs in valuations and market behavior could position defensively. People who believed the new paradigm story rode stocks all the way down. History doesn't repeat, but it rhymes. And right now, it's rhyming with periods that came before major dislocations. The exact trigger might be different. The specific cascade of events might unfold differently. But the underlying dynamics, the debt trap, the currency debasement, the fragile confidence, those fundamentals are similar. So what does this mean for you? What should you actually do with this information? Rising silver prices are suggesting that market volatility is likely to increase. The period of calm stability might be ending. Assets that have been carried higher by liquidity and low rates might face pressure. The assumption that central banks can always step in and fix things might be tested. The confidence in paper assets, in promises denominated in dollars, might erode. This doesn't necessarily mean immediate collapse. It doesn't mean run to the hills and buy canned food. What it means is that the probability of disruption is rising. The tail risks are getting fatter. The possibility of outcomes outside the comfortable middle range is increasing. And in that environment, the traditional strategy of buying stocks and bonds and holding them forever might not work as well as it has for the last 15 years. People are starting to recognize that having some exposure to tangible assets makes sense. Not all of your wealth, not even most of it, but some portion allocated to things that aren't dependent on government promises or corporate performance or market liquidity. Things that exist regardless of what happens to the financial system. Silver falls into that category. Silver acts as a mirror reflecting stresses in the system that other assets don't show. And right now, that mirror is showing something concerning. Here's what you need to understand above everything else. Silver prices do not move randomly. They respond to real forces. Stress in monetary systems, pressure in credit markets, changes in confidence, shifts in production and demand, problems in currency purchasing power. When silver begins signaling strain while official narratives remain optimistic, While the news keeps saying everything is fine, history suggests that's exactly the time to pay attention. Silver often speaks quietly. It doesn't make headlines until the move becomes dramatic. But when it does speak, when prices start climbing steadily despite economic uncertainty, when the metal starts behaving like it did before previous crises, it usually tells the truth. Not a comfortable truth. Not a truth that's easy to hear. But truth nonetheless. The US economy faces structural challenges that won't be solved by another round of stimulus or another pivot from the Fed. The debt is too large. The obligations are too extensive. The path forward, whether policymakers admit it or not, involves some combination of inflation, financial repression, and gradual erosion of purchasing power. That's not opinion. That's mathematics. And silver understands mathematics. You can choose to believe the official story. You can choose to trust that everything will work out fine because it always has before. You can choose to ignore the warning signals and hope for the best. That's your right. But understand what you're betting on. You're betting that this time is different. You're betting that debt doesn't matter. You're betting that currency debasement won't affect you. You're betting that the patterns that played out before major crises won't play out again. Or you can do what the smart money does. You can pay attention to the signals. You can recognize when asset prices are telling you something important. You can position yourself for a range of outcomes instead of assuming the best case. You can hold some tangible assets alongside your paper assets. You can prepare for volatility instead of being blindsided by it. Silver is flashing a warning right now. A warning that economic stress is building beneath the surface. A warning that the stability you see might be more fragile than it appears. A warning that changes are coming whether we're ready for them or not. The question isn't whether the warning is real. The pattern is too clear, too consistent across too many historical examples. The question is whether you're going to listen. Because if history teaches us anything, it's this. The people who pay attention to warning signals before everyone else does, they're the ones who survive and thrive when things change. The people who wait for confirmation, who need the crisis to be obvious before they believe it's real, they're the ones who suffer. Silver is telling you something right now. Something important. Something that could matter enormously for your financial future. Are you listening?